So today I'm joined by Peter Petyt of For Rivers. We are going to talk about law firm funding, which we're seeing as an increasing asset class in the UK and elsewhere. And so let's dive in with some questions around the market and around the different types of structures that are available. So welcome, Peter.
Thank you, Emily. Delighted to be joining you.
So let's start off at the beginning. So we've seen a shift in the funding market, particularly in the UK, from more single case, now portfolio, and now law firm type funding opportunities. And we can see that that's been more of a staple part of the US market for some time. What is third-party funding for law firms? What does that look like? And why do you think there's been such a growth in the investment type recently?
Yeah, thank you very much. Well, I suppose we have to look at the drivers behind this, which essentially are the same for whether it's single case or multi-case third-party funding. It's clear that clients are very keen on the law firm being able to offer fee arrangements which require limited or no cash contribution and are basically success-based. But of course, law firms are businesses. They're very cautious about risking their own billable hours and third-party costs if any payment for these depends on an uncertain outcome. So it's vital that law firms have adequate operating capital and working capital. We've seen that they can collapse if they become over-reliant on income from contingency fee cases. So the need for cash flow while acting on a contingency basis is absolutely fundamental for survival. I think that's the driver. Portfolio funding, which is the subject of the research that I'm carrying out alongside my very busy day job, is essentially a form of finance which is provided for and secured against a bundle of cases which are then cross-collateralized. And that cross-collateralization of the portfolio diversifies and reduces the funder's risk, enabling the funder to reduce its overall cost of capital, especially when compared to single case financing, which we know is extremely expensive. So once you've got that law firm portfolio finance secured against these estimated success fees, that allows a drawdown of working capital whilst the cases are in progress. It allows disbursements to be paid, and as we know, disbursements can be very significant in some cases, including, the court and arbitration fees, the experts, the e-disclosure costs, etc. But it can also be used to fund other initiatives such as acquisitions, recruitment, marketing, IT investment. And I think the crucial part of this is that portfolio funding now allows the law firm to offer attractive contingency fee arrangements to its clients, whilst maintaining a sensible level of working capital. And I think unlike bank finance or shareholder equity, it's a structured finance product which is aligned with the successes and failures of a case or a bundle of cases. And that's very attractive because it's non-recourse and it's non-dilutive, unlike equity finance, which we'll talk about in a minute, I'm sure. So there are some real attractions of this sort of finance if it can be structured and secured properly.
I agree. And I think in the cases that we've looked at, law firms are quite appreciative of engaging with a financial source that actually understands their business model. Because I think sort of the more traditional sort of bank finance and other kind of more traditional structures don't always understand the law firm model. And there aren't that many businesses who basically disgorge all of their capital to their shareholders every year. So I think funders are in quite a strong position. Obviously, litigation funding is a more expensive product than a traditional bank loan, but as you've said, that there are other opportunities. How do you see funders viewing the kind of the additional ask? So in terms of not just in terms of the pure funding in respect of a portfolio, but if the law firm is looking for funding that they can deploy more broadly within their business, you mentioned some other items like recruitment and marketing. Do you see funders taking that risk? And does it economically make sense within the context of how funders traditionally get their return?
Yeah, I mean, look, I think at the end of the day, it comes down to the structure of the portfolio and how well diversified and the quality of the cases within the portfolio. Because being simplistic, obviously, the better quality the portfolio is, the more appetite the funder would have to invest within it. Because at the end of the day, you as the funder, of course, you're there to make a return for yourselves and for your stakeholders. And if there's a really good opportunity, why wouldn't you want to put more capital to work? So I think at the end of the day, it does come down to the quality of the portfolio. and the cases within it. And there are many other factors that our research is bringing up here. It's to do with the quality of the law firm itself, its track record, the quality of the fee earners and partners who are running the cases within the portfolio, the general financial security of the firm. All of these are very important factors that would play into, I think, a funder's assessment of how much capital they wanted to put out. So certainly we've seen portfolios that are good enough to invest in, but perhaps only from a funder's point of view to invest in the costs associated with the cases themselves. So yeah, you've got a bundle of cases there. Law firm wants to draw down some working capital to keep its lights on whilst it's running those cases on a contingency basis, and obviously paying the disbursements such as experts during those cases. But perhaps the portfolio is not strong enough to support an additional investment by the funder, which would cover some of those areas that you mentioned, Emily. So I think it does come down to the strength of the portfolio and the cases within it. But certainly the better portfolios that we've looked at and that we've helped advise on would merit an additional investment from the funder if that's what the law firm wanted.
That's great. And I think thinking about different sources of funding for law firms, talked about in your paper the sort of pattern of IPO for law firms and how that sort of tailed off. Why do you think that was? And how do you think law firms are looking to sort of capitalize themselves in the current climate?
I think it's a really interesting and really good question, actually, because it's, again, something that's coming up with the research that we're doing. Well, obviously that in the UK, law firms have been able to raise capital on the public stock exchange since 2012, when alternative business structures, or ABSs as we know them, were brought into play. I think we've looked at a few of the flotations. There haven't been that many of them. I think we'd count Gately, Gordon Dad's, Keystone, Rosenblatt Knights, and DWF. Might have missed a couple there, but that's mainly it. Look, on the face of it, obviously a public listing allows law firms to raise cash, which can enable it to fund contingency style cases. And actually with Rosenblatt, it's quite interesting because they raised some cash to actually set up an independent fund. Although that's subsequently changed now, and Tetz and his colleagues have taken that into a different direction. But there hasn't been a flotation that I'm aware of on the UK market since 2019. And I know Mishcons were looking at doing an IPO in early 2023, which was pulled. I think they incurred about £12 million worth of expenses that were aborted. So it's not a cheap exercise either. So yeah, I think only Gately and Keystone have got share prices higher than their original listing, and there've been some casualties as well. So it's clearly not necessarily a very positive trend. The reasons for that, I think, are multifarious, and I think sometimes it's very difficult to persuade a structure such as a law firm to go that way, because they're very used to running the law firms themselves. They're having a lot of autonomy in how they do that, to being able to sort of draw down partner distributions on a yearly basis. So if the firm has a really good year, they cash in and look at it on that basis, rather than with a flotation where you're going to have to rein in that yearly remuneration and answer to external shareholders and stakeholders. Okay, yes, you're building capital value for the future in theory, but you're not necessarily sure when you can cash that in. I mean, clearly when law firms float, there are restrictions on when the partners can actually cash in those shares. And I think it's just such an unusual and new concept for them to look at that many of them don't really buy it. And as I say, at the moment, if you look at the track record and the share prices, there's not a convincing trend there that show that you are going to develop that much value beyond what you would do under a traditional structure. So I think it's certainly unproven. I would say that there's plenty of time for this to change. It's pretty nascent still, but so far, I don't think the evidence is particularly persuasive. What happens in other places like the US now that the regulatory environment is changing here is a completely different issue. And we can talk about that as well, because certain states in the US are now open to external ownership of law firms, but we haven't seen a public flotation, and I'm not aware that there's a plan to do that anytime soon. So the UK is an interesting laboratory for this, and I would say that the results are not particularly convincing to date.
Yeah, I mean, I think I agree with that. And I've had discussions with various law firms around, why and why not to float. And I think one of the arguments why not to float is sort of a future looking one. So yes, maybe you can secure the firm with the capital, but are you securing the people? Because the partners who are there at the flotation are obviously going to have a big payday eventually, but those who are coming up behind them are then not going to benefit from the same structure and maybe remuneration that those partners who were there at the IPO had. So
Right.
with a minority of firms actually going through this, then it may make those firms less attractive to kind of up and coming junior partners. So I think one of the arguments against that I've heard here is exactly that. So you're not really safeguarding your future talent pipeline.
No, I think that's absolutely right. So it's just, I think there's a lot of uncertainty around it, and if there were a track record of 20 years worth of value creation, I'm sure people would feel a bit more comfortable about it, but there isn't. And I think until you get that, then there will be skepticism and reluctance for this to happen too often.
Before we move on to talking about litigation funding for law firms, you mentioned the US and change in regulations there, which is enabling other ownership of firms and other sort of profit sharing in some US states. Do you want to just say a bit more about that? I think we've seen some case structuring to enable that to happen, and some firms maybe potentially moving to the more like Arizona and Utah and the states, which I think are more attractive for that structure. But perhaps if you could just sort of explain from your side and from what you're seeing on the ground, that'd be great.
Well, that's also, I would say, very, very nascent. we're in the very, very early stages of all this happening. So yes, Arizona and Utah are the outliers here. They're the ones that have kind of gone out on a limb and said, right, yes, we will permit external ownership of law firms. And inevitably, because of that, you've seen quite a few, not necessarily traditional law firms. I mean, there are some more tech legal services firms as well, who are going into Arizona and Utah, which I think has a sandbox, as they call it, to set up and establish, and then to allow themselves basically to attract non-lawyer ownership. Whether that's through capital, a financial investor coming in, such as a private equity house or a family office, or even an individual, but also bringing in non-lawyers as owners of the firm, who may have completely different skill sets. So you see CEOs coming in, CFOs. They're attracting people with different skill sets who are nonetheless incredibly important to run a modern organization and bring in those non-legal skills that are important. So yes, there's been quite an influx of cases into Arizona and Utah. Other states have talked about it. California, where I'm currently based, is looking at it, but has knocked it back a few times. Florida, the same. And I think one of the law professors over here, Victoria Sahani, described it that the UK is a laboratory with 50 different departments or 50 different laboratories, and they're all a bit different. All of the states have different regulations. I know some funders over here are very concerned about investing even in portfolios, actually, in some states, because of the potential issue of fee sharing rules. We can talk about that separately. So you've got certain states over here that are much more resistant to any of these kind of structures than others. But look, I think the UK definitely started the trend in 2012 with the introduction of ABSs. And as I say, so far, I think the results of that are somewhat uncertain and variable. Over here, I just don't think that there is enough of a track record at the moment to show what's going on. However, if you do want to set something up over here and bring in external owners and non-lawyer owners of firms, these are the places to do it. Arizona and Utah, they're the ones that have actually opened the doors and said, yes, we want to try and make this work. I think if you and I talk in a year or 2 years or 3 years time, there'll be more evidence to talk about. But I just think at the moment it's very nascent.
Do you think that sort of the opening up of fee sharing or third-party ownership of law firms will lead to some sort of vertical integration in the market? So in the UK, we've seen some funders acquiring shares or acquiring law firms. So there's sort of some vertical integration there, so that there's the sort of the shareholder investment in the law firm and then using that law firm partly for sort of diligence in the business, but partly also to sort of fund the cases. Do you think that kind of structure could open up in the US?
Yes, I think I think it's entirely possible. I think that at the end of the day, if you're going to go for vertical integration, you're probably looking at synergies and cross referral opportunities and other benefits like that. I guess the bigger question is probably on a litigation funder having an equity stake in a law firm, and what compliance and potential conflicts does that bring up? The obvious, I suppose, example to bring about this is when Burford took a stake in PCB litigation. This is obviously in the UK. So took an equity stake as well as providing funding for a portfolio of cases. And, Burford had been very vocal about this and saying this is a real opportunity. This is a real opportunity for law firms to take the benefit of capital from funders, as well as obviously the expertise and experience that you get by working with a funder generally. And I think that's absolutely right. But equally, Burford were fairly vocal about the fact that the SRA were quite difficult about that. And they got the deal through in the end, but it wasn't easy by all accounts. So I think this continual sort of issue that you have with conflicts and whether a funder should be influencing the decisions of a law firm and the strategy of a law firm on individual cases is a perennial issue, isn't it? Because as we all know, although championing maintenance are maybe relics of the past, their influence is still there. And Deminor, as well as other litigation funders that we work with, obviously are very careful about the way that their funding agreements are structured so that the funder is not seen to be having too much influence on the settlement strategy of the case or whatever. So I think that the involvement of a funder, there is a line, I suppose, that can be crossed at some point, and taking an equity ownership is probably pushing that line a bit, because obviously as an equity owner you are going to want to have some kind of influence. That's why people bring in private equity houses and venture capitalists and people like this, because yes, they want the money, but they're not going to get that money without some kind of participation from the investor, whether that's a board seat or whether that's some, even if you look at the way that these these investments are structured, there's usually some rights that the investor has to get more involved if things go wrong. So I think the bigger ethical issue here, and again in the States, I think this would vary from state to state, would be exactly how much do you allow the investors to get involved. But look, at the end of the day, if an external owner can come in, whether that's a litigation funder or just a private equity house or something like that, should enable capital to allow the business to grow and prosper. And access to capital is the lifeblood of any successful business. So with my corporate finance background, I'm obviously all in favour of allowing external investment. The question is, I think, with equity ownership, obviously you're getting dilution of equity. The joy of a portfolio finance facility is it's non-dilutive, and from everyone's aligned. Everyone wants success within that portfolio. Yes, the law firm ultimately would be giving up part of its success fees, but it's, as I say, it's non-dilutive capital. So you're getting an injection of capital without diluting your equity, without diluting your ownership, and I suppose a limited amount of influence from the funder. So I think it's a very neat form of finance, portfolio finance. I really do. The issues are perhaps more practical as to, as I say, getting a portfolio or structuring a portfolio that works, so it's attractive from a funder's point of view, and then being able to work with the law firm to make that happen. And we know this because we see it often. There are lots of frustrations often between funders and law firms because this is quite hard work, structuring a portfolio. You and I were talking before the podcast started about the fact that you have lots of different fee earners within firms. They don't necessarily know what each other is doing. There may be the opportunity to structure a fantastic portfolio there, but someone's got to get into the weeds and work out how to do that, which is, I hope, where we come in.
I think we've seen in the UK that law firms are getting a bit more sophisticated around funding and putting in place their own sort of internal sort of funding boards where they have a level of coordination between the different fee earners and the different teams. But I agree. I think a portfolio of diversified assets is much more attractive to a funder than, a set of different individual cases from, the same team or the same type of case. I'm sort of balancing that against the kind of portfolios of same claim type, so maybe more consumer cases where obviously it's easier to diligence that and look at track record. But do you have any tips or sort of ways that law firms can kind of approach structuring a portfolio, or how to sort of start that conversation with a funder? Obviously, having somebody to project manage that is very helpful, but where do firms start with that?
Yeah, I think your point about some firms bringing in resources and actually having their own kind of litigation funding departments and is a very interesting one. I mean, obviously, that I think does add a lot of expertise to a law firm's ability to bring in funding, but of course, it's that's only going to be for the bigger firms, I think, who are going to be able to do that. What we're seeing as a potentially much larger market, I suppose, for what we do, is the medium-sized firms and the boutiques who simply don't have the wherewithal to bring in those resources in-house. They need to use someone, hopefully like us, to help them put the portfolio together. The first thing we do is that we go in and we do a kind of bit of a deep dive on the on the firm. Look at the firm's history, look at the fee earners, look at the expertise and the focus, just to make sure that we feel that the firm is going to be credible in front of a funder. That's a very important first step. And then dive a bit deeper into the actual case types. And, we're looking at a spreadsheet to start with, which has a list of cases that have contingency fees attached to them. And then as drilling down and looking at what those different types of cases are, how well diversified they are. I mean, are they genuinely, you've got 4 cases, is one of them a patent case, is one of them a commercial case, is one of them an insolvency case? How much diversification is there in the potential portfolio? Do the numbers work? One has to look at the base values of the contingency fees as opposed to perhaps the maximum values. Will it work on that basis? Will the funder be able to take comfort from that? And then again, look at the uses of the finance. How much does the law firm actually need? What's it looking for in terms of working capital to run those cases? Is all the capital required to run the cases, or is there an additional requirement to fund some other initiatives? There needs to be some kind of cash flow model put in place to show how this will all pan out and show the funder what sort of returns they're going to get over a period of time. There are some other more practical issues. If you have more than one fee earner's cases in a portfolio, one of them goes wrong, is that going to prejudice in any way the partner whose cases go right? These kind of practical on the ground issues are very important, because a law firm's not going to want to do this unless all of those questions can be addressed and answered. So yeah, that's the role that we tend to play. It's quite a deep dive and quite a involved project management role. But our experience shows that if that's not done, these portfolios rarely happen. So I think it's an important role.
I think your point around how much does the firm need is an important one. I mean, the cases that we've looked at, often the firm kind of overestimates their funding need, and actually there can be a way to invest and then maybe recycle within a portfolio, so that the drawdown is not so significant, and then you get some sort of economies of scale in terms of pricing,
right,
versus a pure sort of investment drawdown and then repayment, and then fresh capital type structure. I think diversification as well. I mean, we prefer a diversified portfolio, not tied to any particular claim type. So I think firms, when they're looking at putting together portfolios, if they can do that, and diversification, true diversification, as you were saying, in terms of claim size. So one massive case and three tiny ones is not still not a diversified portfolio.
Right.
So there's a lot to think about. We've talked about sort of equity investment, and we've talked about portfolio investment. Are they the main kind of structures? Are there kind of hybrids that you see for funders to invest in law firms?
Well, it's interesting because the other structure that seems to have been deployed and is talked about quite a lot, which I am quite critical of, being very honest, is what's, I suppose, sometimes known as a pact or a best friends relationship. And in these relationships, this is where the law firm partners with a preferred funder, which finances the law firm fees and expenses on cases where the law firm's clients request it, and the law firm and funder agree the case is worthwhile. There's been a few of those. Well, actually, probably been more than we know about. Actually put in place. Wilkie Farr and Gallagher did a big facility with Longford in 2021. Harbour have done one with Michigan Rea. LCM did one in with DLA. I have to say that I think that these are, as much as anything, marketing exercises, because at the end of the day, they're not portfolios. If funding is secured, the client is still paying for it on a single case basis. It's for the client's account, not for the law firm. So you're not getting any benefits of cross collateralization or diversification. And the very worst part of it is that if the preferred funder decides not to do the case, what chance does that give you in the market of getting a case funded by another funder? Because the other funder is naturally going to be very worried that the preferred funder turned it down. So I have to say, I think that these are marketing exercises as much as anything. I don't think there's any evidence, certainly not that we've come across, that suggests that there's a particular advantage in terms of speed of getting something funded or indeed of pricing. I think the research will bring this out more, and perhaps there will be exceptions to what I've just said. But I think that you have to be very careful in these things, and the conflicts that potentially can arise are not insignificant. So it isn't a portfolio structure, but it's talked about a lot, so we have to address it and discuss it. But I do think otherwise. I mean, you're looking at either pure equity investment from either a funder or an external investor, such as a private equity house, or, as I say, a portfolio finance facility, which is where I think that potentially you can really get the benefits of this. If you look at the publicly announced portfolio facilities, and they're only the ones that have been announced publicly, there may well be more. It's pretty clear that they are genuine portfolio finance facilities. You can, if it's a UK firm, you look at Companies House, you can see that charges are being registered. It's a proper kind of portfolio finance debt facility, and they're going to be the structures that I think are most often deployed going forward in whatever jurisdiction you're looking at, to be honest. So to me, a pure portfolio finance facility is the way forward here, particularly if you as a firm don't want to suffer any dilution of ownership.
Yeah, I guess with all funding structures, it comes down to appetite for the different structures. I think we've seen, and we've had discussions with some of the firms who have entered into the pact type relationships, and we've seen cases coming from those firms. And I think it's right. I mean, that's the first question that I'm asking. Why wasn't it funded?
No.
I think those kind of pact funds where the law firm partners have also invested money into the fund makes it, I understand, difficult sometimes to deploy, because the risk appetite of a law firm partner is not the same as a litigation funder, and so structuring those deals can be quite difficult. So I think we've talked about structures, and we've talked about the benefits of using third-party funding for law firm finance. What about some of the risks to the law firm of using funder capital? What can those be?
Well, I think at the end of the day, That's actually quite a difficult question to answer because being an advisor on third party funding and working with high quality funders such as yourself, Emily, um, we're doing it because we think that actually the risks from a law firm's point of view are quite small. We're helping advise them on raising capital that's allowing them to grow and prosper within their businesses. And obviously, therefore, we're only going to be talking with investors or funds who we believe are credible and have got the right expertise and experience, and can add more value apart from just the money. As much as anything, I mean, we know. I mean, we've seen it before. You bring a funder in, of course, you're going to get money, but you're going to get many years of experience. You guys as funders see cases every day. You really understand what's going on in the market, and you can bring a lot of added value just as essentially a strategic advisor, apart from just putting the money in. So I would say that again, from a portfolio funding point of view, just looking at that, having the involvement of a high class credible funder is a big value add. Now, can it go wrong? Of course, any finance facility can go wrong. I think mainly it's going to go wrong if there are perhaps if expectations haven't been managed at the beginning. A really simplistic comment is often that you agree a facility at the beginning and then there's a big win, and they're having to hand over a lot of that win to the funder who's backed them. And at that point, I think that partners in firms and law firm management have to be their expectations have to be managed. And that's, again, something we do quite a lot of. We're saying, look, everyone's aligned here, but you do know, obviously, if you do get a big win, that a chunk of that's going to have to be handed over to the people that backed you. I do think also that the management of individual partners within portfolios is important because, as I said earlier, if one of their cases goes wrong, does the partner whose case goes right suffer as a result of the one that's gone wrong? And I think, again, managing that and making sure the law firm has a structure in place to handle that so that there's no harm done to the successful partner as a result of that is quite important. So I think there are practical issues that need to be managed there. But look, at the end of the day, I think if the thing is structured right at the start, and we're bringing in a very, very good funder, they become a strategic partner to the law firm, and that should work well. Things can go wrong, yes, people can fall out. Law firms change, partners leave sometimes, and move on. How much effect will that have on the ongoing portfolio? Yes, that has to be looked at as well. That's a risk. Difficult times out there at the moment, challenging economic times. Law firms can suffer for other reasons. Is that going to in any way be an issue going forward, the financial stability of the law firm? All of these things need to be considered, but hopefully it's set up as a successful partnership, and indeed the funder then becomes a real ally if times do become challenging.
I think there's two things there that I wanted to pick up on. I think credible funder is key, and having somebody who can navigate the market and understands who the credible funders are is really important. I think we've seen some reports in the press recently around deals that have been signed and the funder didn't have the capital to pay the drawdowns. And I mean, even from being part of the market, that's really disappointing. I mean, we're a member of the Association of Litigation Funders, and we obviously have to meet capital adequacy requirements to become a member of that organisation. But I think there are some more kind of, I'm going to call them broker funders in the market who operate in a different way, and being able to understand how the funders are capitalised and to navigate law firms to a best fit is a really helpful contribution to structuring that kind of deal, because law firms are not going to know. The second thing I was going to pick up on is sort of the adding value. I think, since I've joined Deminor, I've seen more cases in a year than I have seen in my entire career so far. So talking to different, talking to different firms, different claim types, different strategies. So, funders, we do have a lot of knowledge, but, in certain jurisdictions, from a regulatory point of view, you have to be a passive funder. And if you've gone forward and backed a case, then obviously you're bringing all of that knowledge to the table in supporting the claim that's being put together by the law firm. I think one risk for a funder in investing in a law firm, and particularly if it's an equity investment, is what does the exit look like? How do we exit?
Yeah, absolutely, and that that means that there's going to need to be some kind of anticipated transaction down the line, which obviously that's what private equity does most of the time. It's investing because of the exit. Yes, there may be some kind of yield before then in terms of dividends or whatever, but normally it's predicated on the exit. So that's a really, really good point. And yes, as I say, we just haven't seen much of it recently, or to date. And I suppose it's then going to come down to, well, okay, what are the exit opportunities? Is it a trade sale? Is it an IPO? Is it some kind of other buyout or whatever? I think as the market matures, that will happen more often, but it's very early stages at the moment. I just wanted to go back to what you were saying about credible funders. I mean, this is a very important area, and something that we police as carefully as we can. A lot of funders, for obvious reasons, they have lots of offshore structures from a tax point of view. So the transparency on what capital they have available is quite limited. So often you're using other means to judge whether you think a funder is credible or not, and that can be, as much as anything, just keeping your ears to the ground and finding out what's happening, who's doing what. Obviously, if you get big exits from funders, if lots of teams leave, I mean that happened last year. 5 people from one funder went to another one. It's not a particularly good sign from the funder that's being exited. And you're absolutely right. I mean, there are funders out there who once had capital, who now don't have capital, but are still holding themselves out to be a principal funder. As I say, we talk to lots of people every day. We try and find out what's happening so that at least we know then that if we're working on a project that we're only dealing with funders who we know have money and know hopefully are there for the long term. But you can never be 100% guaranteed.
Do you think that's an issue, the trust issue? So, I mean, we're a balance sheet funder with onshore capital, so we're maybe a bit more atypical in the London market, and we've been encouraged to set up offshore structures, particularly by insurers who prefer
I'm
that.
sure you have.
But I guess from the discussions you've had with law firms, does that kind of come into their decision as to sort of trusting the funder and understanding the structure of the funder and before they enter into a business partnership with that organisation? Yeah,
I think it is, and to a certain extent, obviously, they're going to be relying on our judgment of that as well. So we genuinely are not going to be taking a client to a funder unless we believe that funder is credible, well financed, and can, as I say, bring other value to the table. Of course, there are three funders out there who are publicly quoted. So you've got a bit more visibility with them. But the vast majority of funders, no, I mean, you haven't got that visibility. It's in the UK, sometimes you have a bit more visibility because of Companies House, so they're filing accounts. But even that won't tell you the whole story, because often there will be some kind of offshore structure in place where the capital might sit. So it's very difficult to be conclusive about it. And that's why I think it's almost comes down to a coal face type judgment. As I say, we're talking with people every day. I talk with people who are potentially my competitors. We swap notes in a very friendly way. And there's been some interesting conclusions that have been drawn from those conversations. I mean, we've found out things that perhaps weren't publicly known that are quite important. So, yeah, I think it's a very important issue.
I think just to finish, it would be good to pick up on a point that you made earlier around the ethics of litigation funders investing in law firms. So do the conflict of interest point. So are there going to be conflicts between what the funder wants out of the relationship and what the law firm's looking for? Are the lawyers within the firm meeting their professional obligations to the client in making sure they secure the best deal? What kinds of ethical issues can arise in this situation, and how can law firms safeguard themselves and funders?
Yeah, I mean, this is where I think it's important that you're looking at the law firm essentially offering a contingency fee to its client, because then essentially the finance is wrapped up in that contingency fee. So the law firm's saying, okay, I'm going to take on this case, and here's my contingency fee structure. I get X% if it settles before this date, or Y% if it goes to trial. And that's all wrapped up in one contingency fee. It's a very elegant, very simple solution. It doesn't mean you have a law firm retainer agreement and a funding agreement and potentially an insurance agreement as well. Everything's wrapped up in one. And I think that way, the client obviously is going to take advice on whether they want to accept the contingency fee arrangement or not. But if they're happy to, then that's it. And whatever arrangements the funder has with a litigation funder are in the background. They potentially have no impact on the relationship between the law firm and the client. And that's why a portfolio facility, I think, works so well, because you kind of remove those conflicts. As we were saying about the pact relationship, where a law firm is saying you should go to our preferred funder, but the cost of that finance is going to be for your accounts. Well, that's potentially an issue because the law firm is trying to push them towards a source of finance which may not be in their best interest. So that's why I think the pact relationship is flawed. So I think it kind of comes down to, is it the law firm that's taking the finance onto its balance sheet, or is the claimant ultimately going to have to take out a separate finance agreement? That's where the conflict issue potentially arises. So I don't have a problem if a funder puts an equity investment into a firm and adds on a portfolio facility, but then the firm offers a contingency style arrangement to its client. I don't think there's an issue. I think that's actually quite an elegant solution, and one that we encourage. Because sometimes we also have claimants coming to us directly without having a law firm in place. So part of our toolkit is to take them to a funder that does have a portfolio facility and negotiate what is we think a competitive contingency fee arrangement.
Brilliant. Thanks very much, Peter. That's been a wide-ranging and interesting conversation.
I've enjoyed it very much, Emily. Thank you for allowing me to be on it.
Perfect. And thanks everyone for joining. Please join our next episode to look at other aspects of litigation funding.